What if the biggest wealth opportunity of this decade isn't hiding in crypto charts, but quietly training models, crunching data, and learning faster than any human ever could? Everyone is still arguing about Bitcoin cycles, halving events, and the next altcoin season, while a different kind of revolution is compounding in the background. Not loud, not hyped the same way, but building the digital infrastructure that the entire future economy will run on. Artificial intelligence isn't just another trend. It's not just chatbots, cool images, or viral apps. It's the backbone of the next industrial era. Automating decisions, optimizing industries, accelerating research, and redefining how money itself is made. And just like the early days of crypto, most people are only seeing the surface, while a handful of investors are quietly positioning themselves underneath it. Here's the uncomfortable truth. By the time AI companies are household names, the life-changing gains will already be gone. The real opportunity exists before the headlines, before the mainstream ETFs, before your favorite news channel starts calling it the future. The million-dollar moves are made when projects are still misunderstood, undervalued, and hiding in plain sight. Think back to early crypto. The biggest returns didn't come from buying Bitcoin after everyone agreed it was revolutionary. They came from recognizing the infrastructure early. Exchanges, smart contract platforms, scaling solutions, data networks. The investors who understood the tech beneath the hype built generational wealth. We are now at that same kind of moment, but in AI. Right now, there are AI projects solving problems most people don't even realize exist yet. Companies building the data pipelines that feed machine learning models. Startups creating the chips and computing layers required to power AI at scale. Platforms developing decentralized AI marketplaces. Tools enabling autonomous agents to operate across financial systems. These aren't flashy meme plays. They're the digital railroads of the AI economy. And the market hasn't fully priced them in. While retail investors chase yesterday's narratives, smart capital is asking different questions. Who owns the data? Who controls the compute? Who builds the models? Who monetizes the outputs? Because in the AI era, those layers are where exponential value accumulates. This isn't about gambling on random tech buzzwords. It's about applying the same analytical discipline that worked in crypto, studying tokenomics, utility, adoption curves, developer activity, real-world integration, and now using that framework to uncover AI projects with asymmetric upside. Opportunities where the downside is limited by real utility, but the upside is tied to an industry projected to reshape trillions of dollars in global markets. The shift is already happening. AI is being embedded into finance, healthcare, logistics, defense, education, content creation, and cybersecurity. Entire job categories will evolve. Entire business models will be rebuilt. And behind each transformation will be specific platforms, protocols, and infrastructure layers capturing the value. Most people will only invest in AI once it feels safe, once it's obvious, once prices already reflect mass adoption. But legacies aren't built in the obvious phase. They're built in the discovery phase, when conviction comes from research, not headlines. When you're early enough that growth multiplies your capital, not just inches it forward. When you position yourself not just for the next market cycle, but for the next technological era. In this video, we're stepping beyond the standard crypto narrative and into the deeper game, identifying undervalued AI opportunities with the potential for exponential long-term growth. Not hype, not noise, but overlooked sectors, emerging platforms, and strategic angles that most investors are still sleeping on. Because the next wave of wealth won't just come from digital money, it will come from the intelligence that powers the digital world. And the people who recognize that early won't just make profits, they'll build a legacy. Everyone loves the story of the person who bought Bitcoin early, forgot about it, and woke up a millionaire. It's the modern gold rush fantasy. One perfect decision, one asset, one life-changing outcome. But here's the part nobody wants to say out loud anymore. That story is history. Not because Bitcoin is dead, not because it has no future, but because the asymmetric opportunity, the kind that turns a few $1,000s into generational wealth, mostly belonged to a different era. An era when hardly anyone understood crypto, institutions weren't involved, regulations were unclear, and the market was still discovering what this technology even meant. Back then, Bitcoin wasn't just an asset. It was an experiment, a rebellion, a question mark with a price tag. Today, it's a recognized macro asset, tracked by funds, discussed by governments, and traded by institutions with billion-dollar balance sheets. That legitimacy is powerful, but it also changes the game. The upside is no longer driven by obscurity. It's driven by scale, stability, and global adoption, which means slower, heavier, more predictable growth. That's great for preservation. It's not the same for transformation. Yet millions of investors are still chasing Bitcoin like it's 2013 or 2017, hoping history will repeat itself exactly the same way. They're anchored to past returns, emotionally attached to old narratives, and convinced that simply holding longer is the only strategy they need. This is the crypto mirage. It looks like the same opportunity. It feels like the same excitement. But the risk-to-reward equation has fundamentally shifted. The early adopter edge, the informational advantage, the disbelief discount, the extreme asymmetry, has largely faded for Bitcoin. What remains is a powerful asset, yes, but not the only, and possibly not the most explosive path to seven-figure outcomes. And this is where market cycles come in. Every cycle in crypto creates new winners. Not just new prices, new narratives, new technologies, new infrastructure layers. In the early days, it was Bitcoin, then smart contracts, then DeFi, then NFTs, then scaling solutions. Each wave created fresh millionaires who weren't just loyal to the last cycle. They were paying attention to where innovation was actually moving. But many traditional crypto maxes are stuck fighting the last war. They believe the only safe bet is what already proved itself. They dismiss emerging sectors as distractions. They measure everything against Bitcoin dominance instead of asking a more important question: where is new value actually being created right now? Because markets don't reward nostalgia. They reward relevance. The next wave of wealth in digital assets won't come purely from speculative hype cycles where prices pump with no foundation. Those phases still exist, but they're shorter, more crowded, and far more dangerous than before. Easy gains get replaced by brutal volatility, and late entrants become exit liquidity for smarter, earlier capital. The smarter play now is different. It's about shifting focus from pure speculation to real-world utility and intrinsic value. Projects that solve actual problems. Protocols that power real applications. Platforms that generate revenue, enable industries, or provide critical digital infrastructure. Assets connected to genuine demand, not just social media momentum. This is where the mirage fades and clarity begins. Because when you look beyond Bitcoin as the only path, the landscape gets much bigger. You start seeing opportunities tied to emerging technologies, decentralized infrastructure, AI integration, data networks, financial rails, and digital ownership models that extend far beyond number go up. These are the areas where growth is driven by adoption, not just attention. And adoption is what sustains long-term value. Bitcoin can still be part of a smart strategy. It can act as a foundation, a hedge, a store of value in a volatile world. But building $1 million future today requires more than loyalty to a single asset. It requires understanding where innovation is flowing, where capital is moving next, and where problems are being solved at scale. Because the biggest mistake investors make isn't choosing the wrong asset. It's assuming the last big opportunity is the only one that will ever exist. The crypto market hasn't run out of life-changing potential. It's just evolved. And those willing to see past the mirage, past the comfort of familiar narratives, are the ones who position themselves not for yesterday's gains, but for tomorrow's breakthroughs. Most people think the AI revolution is already priced in. They see trillion-dollar tech companies, viral AI apps, and endless headlines and assume the real opportunity is gone. That all that's left is hype, crowded trades, and overvalued stocks. But that belief is exactly what creates the opportunity. Because the real AI wealth wave isn't sitting on the surface where everyone is looking. It's forming underneath, in the layers most investors don't understand, can't easily explain, and therefore completely overlook. This is where fortunes are built, not in the obvious, in the underestimated. So what does undervalued AI actually mean? It doesn't mean chasing every company that adds AI to its pitch deck. It doesn't mean buying into flashy demos or short-term hype cycles. Undervalued AI lives deeper than that, in the foundational technologies quietly powering the entire ecosystem. The compute infrastructure that trains massive models, the data pipelines that feed them, the specialized hardware that makes AI faster and cheaper, the middleware that allows AI systems to connect, transact, and operate autonomously. These are the digital equivalents of roads, electricity, and railways during past industrial booms. Not glamorous, not viral, but absolutely essential. And when entire industries begin to rely on them, their value compounds in ways the market often underestimates, until it's too late. Right now, we're in a phase where AI feels visible, but its infrastructure layer is still mispriced. That's a classic market inefficiency. Mainstream investors tend to move in waves of attention. First, they notice the consumer-facing products, the chatbots, the image generators, the tools they can personally use. Only later do they start asking the deeper questions. Who supplies the compute? Who owns the data? Who provides the frameworks? Who enables AI systems to act in the real world? By the time those questions hit the mainstream, early positioning is already paying off. This disconnect exists because foundational AI is complex. It requires understanding technology stacks, long-term adoption curves, and second-order effects. It's easier to buy what you can see and use today than to invest in the invisible layers that make it possible. But complexity is where inefficiency hides, and inefficiency is where outsized returns come from. We're also at a unique moment where AI is crossing from software novelty into physical and economic reality. It's no longer just about generating text or images. It's about machines making decisions, systems optimizing themselves, and digital intelligence interacting with the real world. That's where truly disruptive sectors are emerging. Advanced robotics is one of them. AI-driven machines are moving from controlled factory settings into dynamic environments, warehouses, hospitals, farms, and even homes. The companies building the perception systems, control software, and hardware integration layers for these robots are laying the groundwork for a labor transformation that could reshape global productivity. Then there's the rise of personalized AI platforms. Instead of one-size-fits-all tools, we're moving toward AI systems tailored to individuals. Personal financial co-pilots, health optimization assistants, learning companions, creative partners. Behind these experiences are platforms managing identity, data ownership, model customization, and secure interaction layers. These aren't just apps. They're new digital ecosystems centered around the individual. Add to that AI in cybersecurity, autonomous logistics, drug discovery, smart energy grids, and decentralized AI networks. And you start to see the real picture. AI isn't a single industry. It's a force multiplier across every industry. And each transformation creates new infrastructure, new platforms, and new value capture points. The market hasn't fully mapped this yet. Capital is still concentrated in the most visible names, while the deeper layers, the enablers, connectors, and accelerators, remain comparatively underfollowed. That's the blueprint, not chasing what's already obvious, not buying into narratives after they peak, but identifying where intelligence is becoming essential, where adoption is inevitable, and where value hasn't yet been fully recognized. Because the AI revolution won't just create better apps, it will create entirely new economic rails. And the investors who understand those rails early won't just ride the wave. They'll own the tracks. If you only look where everyone else is looking, you'll only find what everyone else already owns. That's the trap most investors fall into with AI. They stick to the biggest, safest, most talked about companies. The tech giants, the mega caps, the names that dominate headlines. And while those companies may continue to grow, the explosive, portfolio-changing upside rarely lives at the top. It lives earlier, smaller, less obvious. That's where strategic scouting comes in. The skill of systematically finding AI innovators before they become mainstream stories. Because the next breakout AI success probably doesn't look like a polished giant yet. It looks like a small, focused team solving a very specific, very real problem with technology that's years ahead of market awareness. Going beyond the tech giants means shifting your mindset from brand recognition to capability recognition. Instead of asking, "Is this company famous?" you start asking, "Are they building core technology others will depend on? Are they solving a bottleneck in the AI pipeline? Are they enabling speed, scale, or cost reductions that unlock new markets?" Many of the most promising AI opportunities are small cap companies or early stage projects working on niche but critical layers. Model optimization, edge AI deployment, synthetic data generation, robotics perception systems, AI security frameworks, or vertical specific AI for industries like healthcare, manufacturing, or logistics. These businesses don't always trend on social media, but they often sit in positions where, if AI adoption accelerates as expected, demand for what they provide can surge exponentially. But finding them isn't about luck, it's about process. Real scouting relies on structured due diligence, not hype. First, look at the technology depth. Is the company building original models, tools, or infrastructure, or just wrapping existing APIs with a shiny interface? True innovators usually have technical defensibility, proprietary data, unique architectures, patents, or performance advantages that are hard to replicate. Next, evaluate real-world traction. Not just user numbers, but meaningful adoption. Are businesses paying for the solution? Are there pilot programs with credible partners? Is the product integrated into workflows where switching costs will grow over time? Early revenue quality often matters more than raw growth speed. Then comes one of the most overlooked factors, the team. In frontier industries like AI, the team is often the biggest asset. Strong signals include founders or lead engineers with deep backgrounds in machine learning, robotics, distributed systems, or domain-specific expertise. Experience shipping real products matters more than flashy titles. A small team that has built and scaled before can outperform a large team chasing trends. Also, watch how teams communicate. Are they transparent about limitations and roadmaps, or do they rely on vague, buzzword-heavy promises? Builders tend to talk specifics. Promoters talk in slogans. And then there's capital efficiency. Some of the best AI companies don't just burn cash chasing growth. They focus on building leverage, tools or platforms where each improvement increases scalability without proportional cost. That's where long-term value compounds. But as opportunity grows, so does noise. AI is the hottest label in tech right now, and that attracts pump and dump schemes and overhyped projects trying to ride the wave without real substance. Major red flags? Projects that mention AI everywhere, but never clearly explain what their system actually does. White papers or websites filled with buzzwords but lacking technical detail. No credible technical team or founders with no background in the field they claim to revolutionize. Token or stock promotions driven primarily by influencers instead of product milestones. Unrealistic claims like guaranteed performance, fully autonomous everything, or timelines that ignore the complexity of real AI development. Another warning sign is when valuation runs far ahead of product maturity. If a project has massive market hype but no working product, no real users, and no clear path to revenue, you're likely looking at speculation detached from fundamentals. Strategic scouting means staying curious, but also staying skeptical. It's about combining vision with verification, seeing where AI could reshape industries while demanding evidence that a specific team is actually positioned to make that happen. Because the goal isn't just to invest in AI, it's to find the builders of essential AI infrastructure and applications before the crowd recognizes their importance. That's how hidden gems are found, not by following the spotlight, but by learning how to see in the dark. Building wealth in AI isn't about one lucky pick. It's about constructing a system that can grow, adapt, and compound over time. A portfolio designed not just for the next spike, but for the next decade of technological transformation. Because real legacy wealth rarely comes from a single trade. It comes from structure, patience, and smart scaling. The first step is understanding that AI is not one theme. It's an ecosystem. And your portfolio should reflect that. A strong AI portfolio balances stability, growth, and asymmetric upside. At the foundation, you might have exposure to larger, more established companies or platforms deeply embedded in AI development and deployment. These act as your stabilizers. Businesses with real revenue, global reach, and the resources to stay competitive as the industry evolves. They may not 50 times overnight, but they anchor your portfolio to the broader expansion of AI adoption. Then comes the growth layer. Mid-sized innovators building specialized tools, infrastructure, or vertical AI solutions. These are companies or projects already showing traction, but still early enough in their life cycle that expansion into new markets can significantly increase their value. This layer often delivers the strongest balance between risk and reward. At the top sits the asymmetric layer. Smaller, earlier stage AI plays with higher uncertainty but massive potential. These could be breakthroughs in robotics, decentralized AI networks, edge computing, or personalized AI platforms. Not all of them will win, but the few that do can dramatically outperform and pull your entire portfolio upward. Diversification here isn't about owning dozens of random names. It's about spreading across different AI value layers: compute, data, models, applications, and integration into real-world industries. That way, you're not dependent on a single trend within AI. You're positioned for the expansion of the entire ecosystem. But even the best portfolio structure fails without the right mindset. AI investing rewards those who think in years, not weeks. In the short term, markets are noisy. Prices swing on headlines, hype cycles, and fear. Projects that are quietly building can lag behind louder, more speculative plays. This is where many investors lose their edge. They abandon strong long-term positions because something else is moving faster right now. But transformative technologies don't grow in straight lines. They move in waves of innovation, adoption, consolidation, and breakout. The investors who benefit most are those who allow time for technology to mature, partnerships to form, products to improve, and markets to catch up with reality. Patience isn't passive. It's a strategic decision to let compounding work. Because while traders chase short-term volatility, long-term investors capture structural growth, the kind that happens when AI moves from experimental to essential across industries. That's also where reinvestment becomes powerful. As parts of your AI portfolio grow, you can strategically rebalance, trimming positions that have run far ahead of fundamentals and reallocating into newer or still undervalued segments of the AI landscape. This helps lock in gains while keeping your capital exposed to future waves of innovation. Reinvestment also means using profits to increase exposure during periods of market fear when strong projects are temporarily discounted. Over time, this disciplined scaling can dramatically accelerate compounding, turning early wins into a larger, more resilient portfolio. The key is to think like an allocator, not a gambler. You're not just trying to hit big. You're building a self-reinforcing engine where gains are recycled into new opportunities, risk is managed across layers, and exposure grows alongside the industry itself. Because the AI revolution isn't a single moment. It's a long arc of technological and economic change, and those who approach it with structure, patience, and intelligent reinvestment won't just participate in the growth, they'll turn it into a lasting legacy. The future isn't 5 years away. It's not waiting for the perfect time. And it's definitely not going to send you a personal invitation. It's already unfolding in labs, startups, code repositories, data centers, and small teams building the intelligence layer of tomorrow's economy. The only question is, will you just watch it happen or position yourself inside it? Building $1 million AI legacy doesn't start with massive capital. It starts with decisive action and a shift in focus. You don't need to be a venture capitalist. You don't need insider access. You need a framework, consistency, and the willingness to move before everything feels comfortable. Step 1 is simple but powerful. Start learning with intent, not scrolling headlines, not chasing hype, but understanding how AI actually creates value. Learn the layers: data, compute, models, applications. Follow the companies and projects building real infrastructure. When you understand the engine, you stop gambling on noise and start recognizing opportunity. Step 2. Start small, but start strategically. No matter your capital level, the goal is participation and positioning. Even modest investments placed into high-conviction AI opportunities do two things. They give you exposure to growth, and they force you to pay attention. When your money is involved, your learning accelerates. You research deeper. You track developments. You think long-term. This is how investors evolve. Not by waiting to feel ready, but by growing into the role. Next comes consistency over intensity. You don't need one giant move. You need repeated, thoughtful positioning over time. Allocating regularly into promising AI sectors, adjusting as the landscape evolves, and letting compounding do its quiet, powerful work. But here's the part most people overlook. You cannot do this alone in isolation. AI is moving too fast. Breakthroughs happen weekly. New tools, new models, new regulations, new applications. The edge comes from being plugged into communities and continuous learning. Surround yourself, digitally or otherwise, with people discussing AI trends, emerging startups, technical breakthroughs, and market shifts. Read research summaries. Follow builders. Pay attention to where top talent is going. When you're in the right information flow, you start seeing patterns early. And early awareness is one of the most valuable assets an investor can have. As your knowledge grows, so does your conviction. And with conviction comes the ability to hold through volatility, to add during downturns, and to think in years instead of days. That's where the real separation happens, between those who react emotionally and those who build strategically. Now picture where this leads. Not just a bigger portfolio number, but financial flexibility, options, the ability to choose how you spend your time, where you live, what you work on, the freedom to invest in ideas, support family, back causes you care about, or build something of your own. That's what $1 million AI legacy really represents. It's not just wealth, it's leverage over your life. And that legacy doesn't come from chasing every trend. It comes from aligning yourself with one of the most powerful technological shifts in human history, early enough, consistently enough, and intelligently enough that growth works in your favor. The AI revolution is not a distant concept anymore. It's an economic force already reshaping industries. The door is open right now, and the people who step through with curiosity, discipline, and long-term vision won't just witness the future of wealth creation. They'll help build it and own a piece of it. Thanks so much for watching. I truly hope this video gave you value and helped you see new opportunities in a clearer way. If you found it helpful, please take a second to like and subscribe. It really supports the channel and helps us keep creating more powerful, informative content for you. Don't forget to hit the bell icon so you never miss the next update. Your support means a lot, and we're excited to keep bringing you more insights that can make a real difference.